Friends, this is our part 4 lecture of unit number 3. So these are the topics which we are covering in unit number 3, that is our correspondent banking. Already we have covered the objective, introduction, correspondent banking, accounts and other services, nostro vostro loro account, electronic modes of transmission. So for till 3.4 number topic we have covered, and in this lecture we are going to start with NRI banking, and if time permits we will move to this 3.6 number unit also, that is NRI account, rupee and foreign currency account. Most probably we will cover this topic also, and if further time permits we will move to 3.7. So basically we are trying to cover these two topics in this particular lecture. Everything will be explained thoroughly so that you should have conceptual understanding of each and every topic, and whatever topic which we are going to discuss today, expect at least one case study from that topic. That's why this lecture is super important, because you will face one case study based on the things which we are going to discuss just now. So try to understand each and every point which we are covering now. Let's begin with. So we will talk about something super important, especially if you have family or friend living outside India, that is called NRI banking. Now I know this topic can sound a bit complicated, but don't worry, we will break it down together in simple, easy to understand terms. So let's dive in. First thing first, why is NRI banking so important? Well, it is vital for countries like India that have a large number of people living and working abroad. You see, these non-resident Indians or NRI send money back home to their families and invest in Indian businesses. This helps boost Indian foreign exchange reserve. Right, they bolster Indian foreign exchange reserve. This help and these foreign exchange reserves are like a big saving account for the country. More foreign exchange reserve means more economic stability and growth for India. So that's why this foreign exchange reserve plays a crucial role in the development of an economy. Right. So who takes care of NRI banking in India? So it is regulated by the Reserve Bank of India. Or RBI for short. Think of RBI as the country's top bank that makes the rule to keep our money safe. There is also something called FEMA. There is also something called Foreign Exchange Management Act 1999. So this act, along with the RBI, sets the guideline for opening NRI account. So this act along with the RBI sets the guideline for opening NRI account, how these accounts are operated, the money that can be sent back home, and the kind of investment NRI can make in India. See, what are the things covered? First thing is regarding the account opening, how these accounts are operated, the money that can be sent back home, that is called operation, and the kind of investment, that is called repatriability. They can send back home, how much money they can send back home, that is called repatriability. And finally the thing is investment, the kind of investment the NRI can make in India. Right. Now the next question is, what is an NRI? So now let's understand who exactly qualifies as an NRI. According to the Income Tax Act of 1961, NRI is defined based on how long they stay outside India. So how NRI is defined? Based on stay duration outside India, how long they stay outside India. Right. So it's if someone lives outside India for more than 182 days, that's the criteria. If someone lives outside India for more than 182 days during a financial year, they are considered a non-resident Indian. So if you or someone spend more than half the year abroad, so when I say 182 days, this is nothing but 365 divided by 2, right? Almost. So if you spend half the year or more than half the year abroad, then you fall into the NRI category. It is quite simple, right? So hopefully you have understood that if they stay in India for at least 182 days in the preceding financial year, then that is called resident, and if they stay more than 182 days in foreign country, then that is called NRI, non-resident Indian. That's the definition. Now to wrap it up, NRI banking is crucial for India. So let's wrap up the thing which we have covered in this particular slide. NRI banking, why it is crucial for India? Because it helps strengthen the country's foreign exchange reserve. It is regulated by RBI as well as FEMA, and to be considered an NRI, you need to live outside India for more than 182 days in a year. So in the next slide, we will dive deeper into type of NRI account and the benefits they offer. So let's see the next slide. Let's come to the next slide. So this is the condition number B. So in our previous slide, we have talked about what NRI banking is and why it is important. So in this slide, we will dig deeper into what it means to be NRI, especially when it comes to taxation. So to understand NRI status, let's first talk about who is considered a resident of India. So according to the Income Tax Act 1961, the first condition we have already covered in the previous slide, that is condition number A. What was the condition number A? That you are considered resident if you have stayed in India for at least 182 days. If you have stayed in India for at least 182 days in the previous financial year, you are considered a resident, right? That was the condition number A. And now comes the condition number B. So you are also considered a resident if you stay in India for at least 365 days in the last 4 financial year. Try to understand. In the last 4 financial year, if you have stayed in India for at least 365 days and at least 60 days in the preceding financial year, right? So this means that even if you have not spent a lot of time in India in one particular year, you could still be counted as resident if you meet the second criteria, right? So suppose this is 2024, right, and 2020, 21, 22, 23, these 4 years, if you add the number of days you have lived in India, and if after adding it is equal to at least 365 days, it is equal to 365, then it means you are resident. Okay, this is another criteria which is kept in Income Tax Act 1961. So in the last 4 financial year, if you have lived at least 365 days in India, then you will be considered a resident. Okay. Now here is where it goes interesting. Let's move to the next slide. So starting from April 1st 2020, so starting from 1st April 2020, the rules change a bit for the taxation purpose. If you have taxable income of more than 15 lakh, try to understand, if you have taxable income of more than 15 lakh, there is a new way to determine if you are a resident for tax reason or not. So what are the condition? So condition is, first condition is you have your taxable income is more than 15 lakh. Then there is a new way to determine if you are resident for tax reason. You will be treated as resident if you stay in India for at least 120 days in the previous financial year, right? Or if you have spent 365 days in the last 4 financial year. So the stay period was reduced from 182 days to 120 days. See, this amendment have happened in from 1st April 2020. Earlier it was 182 days, as we have discussed just now, that if you have stayed in India for at least 182 days in the preceding financial year, you would be considered resident. But the days has been reduced from 182 days to 120 days. Condition is that your taxable income exceed 15 lakh and you have stayed in India for 120 days, right? This amendment was introduced to prevent individual with significant earning in India from avoiding tax by staying outside for most of the year. Try to understand why it was introduced. See, so to prevent individual with significant earning in India. So suppose someone having more than 15 lakh taxable income, obviously it indicates that he has a significant income in India. Okay, and to prevent him from avoiding tax by staying outside for most of the year. So suppose he is staying outside for most of the year, right, and he is avoiding the tax. To prevent this avoidance, this rule was implemented from April 1st 2020. Is it clear now? Now the next pertinent question is, why do these changes matter? Well, they help to ensure that people who earn a lot of money in India, even if they live abroad for most of the year, pay their fair share of tax here. This is important for maintaining a fair tax system and supporting India's economy, right? So to sum it up, being classified as an a resident or an NRI depend on how long you stay in India and your income level. Two things that decide. First thing that decide is how long you stay in India, right? How long you stay in India, and the second thing that decide is income level. Recent changes have adjusted the rule, especially for those earning more than 15 lakh, to ensure fairness in taxation. So now let's talk about RNOR, right? So what is RNOR? Resident but not ordinary resident, and deemed resident. So we will explain each and every concept related to it. So in the last slide we have talked about how someone is classified as a non-resident India or NRI and the tax implication based on their stay in India. So in this slide we will discuss two terms. The first term we will discuss is regarding RNOR, that is resident but not ordinary resident, and the second term we will discuss is called deemed resident. These two things we will discuss. So this category can be a bit tricky, but we will make them super easy to understand. So let's get started. So what does resident but not ordinary resident or RNOR means? What does it mean? Well, think of it as a middle ground between a full-time resident and non-resident. So suppose at one extreme there is a full-time resident, right? And on the other extreme there is a non-resident. So this RNOR is a middle ground between both of them. So here is how someone qualified as RNOR. The first condition is that stayed outside India for 9 out of the 10 preceding financial year. So if you have been living outside India for at least 9 out of the last 10 years, you might be classified RNOR. The first condition. Is it clear? Now, the second condition is that stayed in India for less than 730 days in the last 7 financial year. Another way to qualify is if you have spent less than 730 days in India during the last 7 years. That's about 2 years worth of day over a 7 period. So you can say this 730 is equivalent to 2 years. So in the last 7 years, if you have stayed for less than 2 years in India, then you will be called RNOR, right? Now the third condition is income over 15 lakh from Indian sources, right? And staying in India. So if you are a PIO means person of India origin or an Indian citizen, and you have more than 15 lakh in income from Indian sources, you will be considered an RNOR if you stayed in India for 120 days or more in the previous financial year and 365 days or more in the last 4 financial year, right? So these are the conditions. In simple terms we can say RNOR status is for people who are resident but have not spent enough time in India recently to be considered fully ordinary resident. This category affect how much tax you have to pay in India, right? Is it clear? So RNOR simply means what? Those people who are resident. Because why they are resident? Because they have stayed for at least 2 years in the last 7 years. They have stayed for at least 120 days in the previous financial year. They have stayed for at least 365 days in the last 4 financial year. So that's why they are resident, but they have not spent enough time in India recently to be considered fully. They are not considered fully ordinary resident. They are considered resident but not ordinary resident, RNOR, right? So this category affect how much tax you have to pay in India. Now let's talk about the deemed resident. The next term that comes into mind is regarding the deemed resident. See, this term is for Indian citizens who are not officially tax resident of any other country but have a significant income from India. Here is what makes someone a deemed resident. The condition is that you are an NRI who is not a tax resident in any other country. The first condition is an NRI not a tax resident of any other country, right? And you have an income of more than 15 lakh. You have income of more than 15 lakh from Indian sources. So first condition is you are an NRI who is not tax resident in any other country and you have an income of more than 15 lakh from Indian sources. So these two things will make you a deemed resident. It is important to note that this category only apply to Indian citizen, not PIO. When I say PIO, it means person of India origin. So the concept of deemed resident help ensure that people with substantial Indian income pay their fair share of taxes, even if they do not live in India full time. So since they have more than 15 lakh income from Indian source, so they should pay fair share of taxes. So this is how deemed resident is classified. What are the two conditions? The first condition is that they are not a tax resident of any other country and their income in India exceed 15 lakh. So such residents should pay taxes. Such deemed residents should pay taxes, fair taxes, even if they don't live in India full time. So finally, let's look at how FEMA 1999 defines an NRI. Till now we have discussed the aspect of Income Tax Act. Now let's come to the FEMA definition. How FEMA define Indian NRI? See, according to FEMA, NRI is someone who is an Indian citizen but live abroad for employment. He is an Indian citizen but he has moved abroad for employment, business or indefinite stay. The second condition is that he is working abroad with foreign government or international agencies like UN, IMF, World Bank. The third condition is that he is an Indian official posted abroad by the central or state government or public sector enterprises. So to wrap up whatever we have discussed in this slide, we have discussed that RNOR and deemed resident are a special category that help define who need to pay taxes in India based on their income and how much time they have spent in the country. And under FEMA, NRI is anyone living abroad for work or government posting. These definitions are important because they help the government make sure everyone pay their fair share. Right? So now, this is one topic regarding the NRI banking. Now let's dive on to the next topic, that is NRI account, rupee and foreign currency accounts. So in the last slide we have talked about who qualifies as an NRI and the tax implication for different residential status. In this slide we will discuss something every NRI need to know about, the type of bank account they can open in India. So if you are an NRI or know someone who is, this video is for you. Let's break down the different NRI account and how they work. First of all, let's talk about NRE account, that is called non-resident external rupee account. So we will discuss each and every type of account, NRE, NRO. Okay, so let's start with the NRE account, that is a non-resident external rupee account. So think of this account as a way for NRI to park their overseas earning in India. So see, we will discuss in detail regarding it. I am just giving you a little bit overview of this account. See, overseas earning, whatever overseas earning NRI have, they want to park their overseas earning in India, but in Indian rupees, right? So that's why this external rupee account is there. Rupee means what? The denomination of this particular account is rupee. So some key features are like this. It is mainly for depositing income earned outside India. The account is maintained in Indian rupees, and the money in NRI account can be freely transferred back to the country where the NRI reside without any restriction. And the tax benefit is that interest earned on the NRI account is tax free in India. So if you are earning abroad and want to save money in India without worrying about tax deduction, NRE account is a great option. The second is NRO account. See, NRO means non-resident ordinary rupee account. This one is a bit different from the NRE account. The purpose here is to manage income earned in India, such as rent, dividend or pension. Currency is similar like NRI account, that is Indian rupees. Repatriability, if we talk about, so the money in NRI account can be transferred abroad, but there are limit. You can repatriate up to $1 million in a financial year after paying the taxes, and taxation is necessary. Interest earned on an NRI account is subject to Indian taxes. So if you are an NRI earning money in India, the NRI account is the way to go for managing those funds. The third type of account is FCNRB. We will discuss in detail each and every account. See, so FCNRB means foreign currency non-resident account. So this account is perfect for those who want to save in foreign currency and avoid currency exchange fluctuation. So the purpose is designed to hold foreign exchange earning in foreign currency. Unlike NRI and NRO account, FCNRB account is maintained in foreign currency like US dollar, euro, Great Britain pound. And if we talk about repatriability, fund in the FCNRB account can be freely transferred back to your country. Just like the NRI account, the interest earned in FCNRB account is tax free in India. So if you are looking to save money in foreign currency without the risk of exchange rate changes, FCNRB is the best way to go. And the last account that we have to deal with is regarding SNRR account, that is the special non-resident rupee account. See, this account is mostly used for business and trade purpose. It is used by NRI who need to conduct business transaction in Indian rupees. The currency, this account is maintained in Indian rupees, just like NRI and NRO account. And if we talk about repatriability, the fund from this SNRR account can be freely transferred abroad, similar to the NRI account. And taxation means interest earned is subjected to the tax based on applicable tax law. So hopefully this concept is clear. So to sum up, NRI have different options to our bank account in India, each serving a different purpose. So if we talk about NRI account, it is for income earned outside India. So whatever income they have earned outside India, this NRI account is the best for them. If we talk about NRO account, this income earned from inside India. FCNRB account to save in foreign currency, and SNRR account for business related transaction in rupees. So understanding these accounts can help you manage your money efficiently and benefit from various tax and repatriability feature. Now let's talk about the requirement of opening account. So we have just discussed the different types of NRI account in India. So we will talk about the requirement for opening this account with a special focus on the NRI account. To open any NRI account, bank usually need few basic things. What is the basic thing that the bank needs? The first thing is application form, right? That is the application in the prescribed form. First you will need to fill out an application form. This form is provided by the bank and it is designed to gather all your necessary detail. So application form is you need to fill an application form. This form is provided by the bank and it is designed to gather all your necessary detail. The second thing is undertaking for permanent return. What does it mean? You also need to sign an undertaking that promise that you will inform the bank if you permanently return to India. This is important because your NRI status may change and so will the type of account you can maintain. So the first thing is you need an application in the prescribed form. The second thing is undertaking for permanent return, and the third thing is necessary document. Lastly, you will need to provide some essential document to confirm your non-resident status. This include copy of your passport, valid visa, employment certificate, right, or any other document that proves your current non-resident status. These are the requirements. Now let's focus on the NRI account first, that is the non-resident external rupee account. So here is what you need to know about opening and maintaining an NRI account. The first thing is source of fund. An NRI account can be opened using money sent from abroad, right? You can see remittance from abroad. You can also open it by tendering foreign currency when you visit India temporarily, by tendering foreign currency during a temporary visit to India. So this is how you can park your fund into the NRI account. The next thing is types of account. The NRI account is quite flexible. It can be opened as a saving account, current account, RD, recurring deposit account, or a term deposit account. This gives you a plenty of options depending on how you want to manage your money. The third thing is joint account. You can open an NRI account jointly with another NRI or a PIO. So it can be opened with other NRI or PIO. If you even have a joint account with a resident relative, but in that case it is on a former or survivor basis. So you can also open joint account with a resident relative, but the conditions would be former or survivor basis. This means that the resident relative can operate the account only if they hold a power of attorney, which allow them to manage the account on your behalf. So this resident relative can operate the account only on the power of attorney basis. It means that which allow them to manage their account on your behalf. Now let's talk about this requirement might seems like a lot, but they are important for a couple of reasons. The first thing is verification. Right. The first thing is verification. What it mean? They help bank verify your identity and ensure that only eligible NRI open this NRI account. The second thing is security. Right. So having proper documentation and undertaking in the place help maintain the security and legality of the international financial transaction. And the third thing is regulatory compliance. These requirements are also necessary to comply with the guidelines set by the Reserve Bank of India. So to open an NRI account, you will need to fill the right form, sign an undertaking about your residency status, provide document like your passport, visa and employment certificate. This account can be funded by remittance from abroad or foreign currency bought during visit to India. You can choose the type of NRI account that suits this particular slide. We will see what transaction you can do with an NRI account, that is called permitted credit. You can see written here what type of transaction you are permitted to do with the NRI account, and we will talk about what kind of credit or deposit are allowed, what debits or withdrawal you can make, and some other facilities this account offers. Let's dive right in. Let's start with the credit, or the money you can deposit into your NRI account. Here is what is allowed. The first thing is inward remittance from outside India. So this means that you can send money directly from your overseas bank account into your NRI account. It is convenient way to keep your saving in Indian rupees while living abroad. The second thing is interest on the account and investment. So any interest you earn from the NRI account itself, you can make or from the the first thing is interest and the second thing is investment. So any interest you earn from the NRI account itself or from the investment you made using this account can be credited back into the account. So whatever interest you have earned on the deposit which is kept in an NRI account, and whatever earning you have done from investment, so that particular earning or interest that can be credited back to the account. This help your saving grow over time without any hassle. The next thing is transfer from other NRI or FCNRB account. If you have any other NRI or FCNRB account, you can transfer money between them. This makes it easier to manage your fund across different accounts without any restriction. The next thing is maturity proceed of investment. If you have made investment using your NRI account and when they mature, the proceed can be deposited back to your NRI account. So suppose you have made investment using your NRI account, whatever money you were having in an NRI account, using that money you have made some investment. So the proceed of that investment can be deposited back to your NRI account. I have already discussed it, right? This include investment like fixed deposit, mutual fund or bond. And the last is currency income. Let's see the next slide. The last thing is current income, not currency, current income. You can also deposit income earned in India, such as rent from property, dividend from share, pension or interest. However, this is subjected to the Indian income tax, so be sure to check this out. Okay, so these are the permitted credit. Again, let me just wind up whatever we have discussed regarding credit. Inward remittance from outside India, interest on the account and investment, transfer from another NRI FCNRB account, maturity proceed of investment made from the account, and the last is current income like rent, dividend, pension and interest. Now let's talk about debits, or in simpler terms, the withdrawal and the payment you can make using your NRI account. The first thing is local disbursement. What does it mean? You can use your NRI account to make payment within India. This could be anything from paying utility bill or any other local expenses. That is called local disbursement. Second thing is remittance outside India. One of the greatest feature of the NRI account is that you can transfer money from this account to your account in your country of residence without any restriction. So this is suppose your NRI account and you want to transfer some money to another account of your friend who is residing in USA, right? And you are also a resident of USA. So you can do that. You can simply transfer money from this account to your account in other country of resident without any restriction. The next thing is transfer to other NRI FC NRB account. Just like with the credit, you can also transfer money from your NRI account to another NRI or FC NRB account. This gives you flexibility in managing your finance. And the last thing is investment in India. So you can use your NRI account to make investment in India, whether it is mutual fund, share or any other financial products. This allows NRI to take advantage of investment opportunity in the Indian market. Let's see what are the other facilities of NRI account. So besides this debit and credit, NRI account offers some handy features like the online banking facilities. So most bank provide internet banking facilities for NRI account, allowing you to manage your account. The next is ATM withdrawal. So you can use an international debit card linked to your NRI account for cash withdrawal in India or abroad. This make accessible to your money quick and easy. The next thing is checkbook facility. NRI account often comes with checkbook, which you can use for payment and transfer within India. This is useful for making large payment or for situation where cash is not convenient. So with an NRI account, you can deposit money from abroad, you can earn interest, you can manage your fund easily, you can also make payment in India, transfer money back home, invest in Indian market, plus you can get all the convenience of online banking, ATM withdrawal and checkbook. Understanding these features can help you make the most of your NRI account. So in the next slide, we will explore the specific benefit and interest rate of the NRI account. Like you can see, facilities in the checkbook deposits, right? So if you have often a saving or current NRI account, you will receive a checkbook. This is super handy for making payment within India. The next thing is repatriation. One of the biggest feature of NRI account is repatriation. So what does full repatriation means? It means you can freely transfer both your principal deposit amount and the interest earned back to your overseas account. So whenever you deposit some money into the bank account, the bank will provide you interest also. So principal amount is there, along with that interest is also there. So full repatriation means you can easily freely transfer both your principal deposit amount and the interest earned back to your overseas account. This is especially useful if you want to keep your saving in India but need the flexibility to access your fund abroad. The next facility is regarding the maturity proceed. If you have an investment that mature like fixed deposit, those proceeds can also be transferred to another NRI or FCNRB account without any restriction. The next facility is regarding the nomination option. So you can nominate either a resident India or another non-resident as the beneficiary of your NRI account. This is a crucial feature for your estate planning, as it ensures that your saving goes to the person who choose in the case something happens to you. Not you who choose, you choose. Now let's talk about the tax exemption in the next slide. So the first thing is, in the interest you earn on your NRI account is completely exempted from Indian income tax. Already we have discussed interest income is exempted from income tax, gift tax, wealth tax. Okay, there is no gift tax or wealth tax applicable to the fund in your NRI account. Just a quick note, the wealth tax was actually abolished in the Union Budget of 2016-2017, so you don't need to worry about that anymore. NRI often need someone to manage their account while they are abroad, and that is where power of attorney comes into picture, right? So the first thing is POA for local payment. So you can give a trusted resident such as a family member the authority to operate your NRI account for local payment like bills or school fee. That is called POA for local payment. Or there is some restrictions. However, POA holder can't make repatriation of fund outside India, make gift or transfer fund out of the account. This is to ensure that your international fund are safeguarded and only used for the purpose you have approved. So remember, the NRI account holder has appointed a POA, but that POA can't make repatriation of fund outside India, can't make gift or transfer fund out of the account. These are the restrictions which have been kept. Now let's discuss the temporary overdrawing facility. So the NRI account holder allowed up to overdraw their account for by up to 50,000. This is a handy feature if you have an urgent payment and don't have enough balance at that moment. The next thing is clearing overdrawn amount. So but remember, this overdrawn amount need to be cleared within 2 weeks. It's like a short-term loan from your bank to cover emergencies. So NRI account comes with a lot of great facility like checkbook, full repatriation of your fund, tax exemption, even power of attorney option for convenience. There is also safety net with the temporary overdrawing features. These facilities makes managing your finance easier while you are living abroad, right? So in the next slide we will talk about a specific feature of the NRO account. Now one thing, we have been discussing about the various features of the NRI account. So today we will focus on what happened when NRI return to India or changes their residential status. So suppose that particular NRI he returned to India and changes their residential status. So in that case, what happened to your NRI account if you decide to move back to India or your residential status change? The thing is account redesignation. So when an NRI return to India permanently, the NRI account need to be converted to regular resident account. So this NRI account is to be converted to regular resident account. It is important to inform your bank about your change in residential status so that they can make that switch. Now let's talk about transfer to RFC account. That is called resident foreign currency account. So RFC account are specifically designed for returning Indians. So we are talking about RFC, resident foreign currency account. So these are designed for returning NRI, allowing them to hold their saving in foreign currency. It provides flexibility if you plan to move abroad again and want to keep your money in foreign currency. Now the interest rate and the duration of fixed deposit in the NRI account are governed by the Reserve Bank of India. You can see interest rate and tenor as per the RBI direction. The interest rate for an RE account as well as the tenor or time period for which you can lock in your fixed deposit are according to the guideline issued by the RBI. Now let's talk about the gift or loan to the relative. So you can give gift, you can provide gifts or provide loan up to USD 2.5 lakh